Hello, this is Jason Sen from daytradeideas.com for ntmarkets.com. Just going to have a quick look at some currencies today. The pound versus the euro, I should say. You can see we've had a bit of a rally up in the last, over the summer from August. I'm just going to open this chart up a little bit. We've managed a good retracement target of 119.32. Our first our 38.2 Fibonacci retracement target. We tried a blip above there. We actually made it as far as 119.63 or 119.69 in fact, but didn't really manage to close above 119.32, barely anyway, and today we've sold off quite heavily. So I think we're overbought in the daily stochastics. We need to turn lower. We've had a good retracement in a bear market really, when you look back over the year, back to summer of 2012, and I think that's it. We've had the correction higher. We're now going to sell off again, and who knows, we might hit the sort of 100-day moving average area of 117.61. That might be our first target. So that's the 200-day moving average, but we could get as far as the 100-day moving average at 117.07. Another interesting market is the Canadian dollar. Been in a nice little uptrend for almost a year now. Nothing too steep, nice and steady. But beginning of this month we started to sell off. Beginning of September, you can see we hovered around the 100-day moving average, which is around 103.41. Well, it is at the moment. Anyway, we couldn't sustain that, and in the end we've sold off. Now, quite interestingly, we're just testing this trend line. You see that it comes in today at around 102.00 area. Anyway, we've also got the 100-day moving average at 102.10, so that sort of 102.10, 101.90 area is good support with trend lines and 200-day moving average. Today's low is 101.82. I'm just going to put some fibs on here as well, because these tie in quite nicely. Hang on. Okay, so you can see, if I just open this up a bit now, that whole move, we've also got Fibonacci support at around the 101.80 level again. So three sort of good areas of support, all within sort of 30 pips of each other. And you can see we've tested this area of support. We're now already bouncing quite nicely off here today, and who knows, we might even close beyond yesterday's close, which was at 102.26. If we close above there, that would be further bullish indication. But today's candle's already looking quite positive with that spike lower, and we're already retracing up towards the opening of today's market. If we do continue higher, as I think we will, we could even get as high as this 100-day moving average at 103.40 over the next few days, but you can see that we've got some resistance from there. We've got some previous highs up here at 103.56, so that sort of 103.5 area should be tricky, but it's a nice little target if we buy into longs here, and we can have a stop just below that 101.70 area. So risk reward wise, that looks quite nice, I think. Going to finish up with a look at the Aussie dollar. Obviously we had a fairly big sell-off for a lot of this year, but we managed to bounce into September. From the beginning of September we've had a really nice little rally, in fact. So the second retracement target on the Fibonacci's would be the 38.2. That's at 95.10. We've given that a good test over the last 2 days, but we haven't managed to close above it. And today we're backing away from it, in fact, which is not a big surprise. We've got very overbought. This is just a bounce in a bear trend to what is always a tough resistance level of 38.2 when you're looking at bear market bounces. So the risk now is for the Aussie to continue lower again. The 100-day moving average isn't that far away at 93.45. I'd suggest that's probably our first target for profit taking, and we'll have to see what happens around that 93.00, 92.75 area. We would really, 92.60. We'd really need to hold above there for any chance of continued gains, but we'll have to see what happens there. If you put a trend line on here, you'll see that the 100-day moving average ties in quite nicely there. So 93.50, 93.45 is going to be very